Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Avery Dennison was founded in 1935 in Los Angeles by R. Stanton Avery, who invented the first practical self-adhesive label. Today, it is the world's largest pressure-sensitive materials manufacturer.
Scale is the competitive advantage in materials. Avery Dennison operates manufacturing across 5 continents, giving it a cost structure that smaller regional label producers cannot match at any volume.
Materials Group accounts for roughly 67% of revenue. It manufactures the self-adhesive face stock, adhesive and release liner used to make labels for food, beverage, personal care, and industrial products.
CEO Dion Stander took over in 2024 after leading the Solutions Group for several years. He came in with direct operational experience in the fastest-growing part of the Avery Dennison business.
Solutions Group is the higher growth segment, serving the global apparel industry with hang tags, price tickets, and increasingly RFID intelligent labels that enable inventory visibility across complex supply chains.
Gross margin runs around 30% and operating margin around 12%, reflecting capital-intensive global materials manufacturing with significant raw material and logistics costs embedded in the structure.
RFID is the most important structural growth driver. Intelligent labels, combining RFID chips with traditional pressure-sensitive materials, are growing at over 20% annually as retailers mandate item-level tracking.
Major retailers, including Walmart, Target, and most European fast fashion brands, now require RFID labels on garments to enable accurate inventory counts. That mandate is not reversing, it is expanding.
Gross margin runs around 30% and operating margin around 12%. Thinner than software businesses, but reflecting the capital-intensive nature of global materials manufacturing at scale.
Major retailers, including Walmart, Target, and European fast fashion brands, require RFID labels on garments to enable accurate inventory counts. That mandate is expanding, not reversing.
Emerging markets represent about 30% of revenue and grow faster than mature markets. Avery Dennison follows brand owner investment into Asia and Latin America with local manufacturing.
Competitively, in materials, Avery Dennison competes with Raflatac, a subsidiary of UPM, and with regional manufacturers. In RFID, it competes with Zebra Technologies and Checkpoint Systems for apparel labels.
The risk is cyclicality in both segments. Apparel supply chains feel consumer demand swings, while materials volumes move with industrial production cycles. Both segments face macroeconomic headwinds.
But RFID provides a structural offset. Even in a flat label market, barcode to RFID conversion drives volume growth from technology adoption rather than underlying economic conditions alone.
The strategic direction under Stander is to grow the Solutions Group's intelligent labels business faster than core materials, shifting the revenue mix toward higher margin, higher growth RFID revenue over time.
For materials sector investors, Avery Dennison's combination of global scale in labels and leading position in intelligent labels makes it one of the more differentiated stories in the packaging and materials space.
That's the company chapter for Avery Dennison. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers, let's go.
Every time you scan an item at checkout, peel a label off a package, or walk past a rack of clothing with a price tag attached, there's a good chance Avery Dennison made that label happen. But the more interesting story is what Avery Dennison is becoming, a company that puts tiny RFID chips inside those labels, turning every item in a retail supply chain into a trackable, scannable data point in real time. Today, we are breaking down Q1 2026 earnings for ticker AVY. The label business is the foundation, the RFID business is the growth engine, and together they make a case that is more compelling than the modest market cap might suggest. Lana, walk us through who Avery Dennison is.
Hudson, Avery Dennison is the global leader in pressure-sensitive labeling materials and packaging solutions. Market cap is approximately $12.5 billion, with the stock trading near $185. Analyst consensus is buy, with price targets around $202. The business operates through two primary segments: label and graphic materials, which is the core pressure-sensitive label business serving consumer goods companies globally, and intelligent labels, which is the RFID segment that is growing at a dramatically faster rate. Dividend yield is about 2% with a consistent buyback program. The company's global scale gives it pricing power in specialty labels and distribution reach that smaller competitors cannot easily replicate. It is not a flashy name, but it is a durable compounder with a genuine high-growth business embedded inside it.
Q1 2026 results were solid. Avery Dennison delivered earnings per share of $2.47 versus a consensus estimate of $2.41, a beat of 2.5%. Revenue for the quarter was $2.26 billion, reflecting both the steady label business and the accelerating intelligent labels contribution. The RFID segment is the number that gets analysts excited, and for good reason. Retail mandates from major players like Walmart and Target are requiring their apparel suppliers to tag every item with an RFID label before it ships. Those mandates drive volume through Avery Dennison's Intelligent Labels platform at a pace that is difficult to model conservatively. The Q1 result confirms that demand is translating into actual revenue and that the adoption wave is not theoretical.
On the income statement, the EPS beat was driven by revenue mix improvement as Intelligent Labels grows as a share of total revenue. RFID labels carry better margins than commodity pressure-sensitive labels, so the mix shift is a structural tailwind for gross margins over time. The label and graphic materials segment remains a solid cash generator, though top-line growth is more modest and tied to global consumer goods volumes. Raw material costs, paper and adhesives, are a recurring line item to watch, and the company has demonstrated pricing discipline to pass through input cost increases over time. Operating expense management was consistent with prior quarters, and the clean EPS beat suggests no unusual one-time items distorted the result.
The moat at Avery Dennison is scale and switching cost. In pressure-sensitive labels, the company is one of only 2 or 3 global players with the manufacturing scale, the materials science expertise, and the supply chain reach to serve multinational consumer goods companies at the volumes they require. If you are a global food and beverage company needing billions of labels annually across dozens of countries, your supplier list is very short. Avery Dennison is on every one of those lists. In intelligent labels, the moat is slightly different. It is the combination of proprietary RFID inlay design, integration with retail inventory management systems, and the embedded relationships with apparel brands and retailers that are mandating RFID adoption. Those relationships are years in the making and difficult to replicate.
Free cash flow at Avery Dennison is consistent and growing. The label and graphic materials segment generates steady cash with modest capital requirements, and Intelligent Labels is beginning to contribute as volumes scale. Working capital management has been a discipline the company has maintained through economic cycles. Capital expenditure requirements are moderate, label manufacturing is not as capital-intensive as heavy industry, and the expanding RFID segment leverages existing manufacturing infrastructure while adding specialized inlay production capacity incrementally. The combination of a durable base business generating reliable cash and a high-growth adjacent segment scaling into profitability gives the free cash flow profile a favorable long-term trajectory. That cash supports the dividend, buybacks, and occasional bolt-on acquisitions.
Capital returns at Avery Dennison are consistent and balanced. The 2% dividend yield is not eye-catching, but the dividend has grown steadily, reflecting management's confidence in the earnings trajectory. The buyback program has been active, and at current prices, repurchasing shares is a reasonable use of capital given the growth profile embedded in the Intelligent Labels segment. Management has not made transformative acquisitions in recent memory, preferring to build the RFID platform organically and through targeted bolt-ons. That capital discipline keeps the balance sheet manageable and avoids the integration risk that can distract management teams during periods of rapid product adoption. The buyback cadence is likely to accelerate as RFID volumes scale and free cash flow grows.
three catalysts that could drive VLTO significantly higher. First, RFID retail mandates expanding beyond apparel. Walmart and Target have focused their initial RFID mandates on apparel, but the technology applies to food, beverage, pharmaceuticals, and logistics. If mandates expand into adjacent categories, Intelligent Labels volume grows far beyond current analyst models. Second, emerging market label volume growth. Consumer goods expansion in Asia, Latin America, and Africa drives secular demand for labeling materials, and Avery Dennison's global manufacturing footprint positions it to capture that growth without major incremental investment. Third, pricing power in specialty labels. As label complexity increases, variable data, smart labels, premium materials, the mix shifts toward higher value products where Avery Dennison commands better margins and faces less commoditization pressure.
The analyst community is constructive on AVY with a buy consensus and a $202 price target, implying roughly 9% upside from current levels. The debate is largely about the pace of RFID adoption and whether the 30% annual growth rate in Intelligent Labels can be sustained. Bulls argue that retail mandate expansion is inevitable and that each new category that adopts RFID represents years of incremental volume. Bears acknowledge the RFID opportunity but worry that the label and graphic materials segment will remain a drag on overall growth and margins. Several analysts have raised price targets after Q1 as the beat reinforced confidence in RFID execution. The stock has re-rated modestly higher over the past year as the Intelligent Labels thesis has gained market credibility.
On valuation, Avery Dennison trades at roughly 22 to 23 times forward earnings, which is a modest premium to the materials sector peer group, but a discount to pure-play RFID or technology companies. The case for paying that multiple rests on the embedded optionality in Intelligent Labels. If the RFID segment continues to grow at 30% or better for several more years, the earnings mix shifts materially toward high-margin technology-adjacent revenue, and the multiple should expand to reflect that. The case against is that 22 to 23 times is not cheap for a company where 70% of revenue is still in a low-growth, margin-compressed label materials business. The bull case requires believing that RFID becomes a meaningfully larger portion of the business over the next 3 to 5 years.
Bull case number 1. RFID adoption accelerates into new retail categories. The current Walmart and Target apparel mandates are just the beginning. Pharmaceutical item-level tracking, food safety traceability requirements, and logistics and supply chain optimization are all end markets where RFID adoption is a question of when, not if. Avery Dennison's Intelligent Labels platform is already the technology of choice for early adopters in these categories. If regulatory or commercial mandates accelerate adoption timelines, the volume ramp in Intelligent Labels would overwhelm current analyst models, and EPS growth would significantly exceed consensus estimates for the next 3 to 5 years.
Bull case number 2. Mix shift to Intelligent Labels drives sustained margin expansion. As RFID grows from roughly 15% of revenue today toward 25 or 30% of revenue over the next several years, the blended gross margin of the company improves structurally. Higher margin RFID revenue replacing lower margin commodity label revenue creates operating leverage that flows through to EPS faster than top-line growth alone would suggest. If management executes on the mix shift while maintaining cost discipline in the label and graphic materials segment, Avery Dennison can deliver mid-teens EPS growth for an extended period, which would make the current 22 times forward multiple look inexpensive in hindsight.
Bull case number 3. Emerging market label volume provides a stable foundation for compounding. While RFID gets the attention, the label and graphic materials segment benefits from a secular tailwind in emerging markets that is often underappreciated. As consumer goods companies expand distribution into Asia, Africa, and Latin America, every new SKU on every new shelf in every new market requires labels. Avery Dennison's global manufacturing network is already in place to serve that demand. This is not a dramatic growth story, but it provides reliable volume and cash generation that funds the RFID investment and supports the dividend and buyback program. The combination of a stable base and a high-growth adjacency is a favorable business architecture for long-term compounding.
Bear case number 1, raw material cost inflation compresses label and graphic materials margins. Paper and adhesive prices have been volatile, and while Avery Dennison has historically passed through cost increases with pricing, there is a lag effect and some customer pushback during periods of rapid inflation. If raw material costs spike again, whether from supply chain disruptions, tariffs, or commodity cycles, margin pressure in the base label business could offset the margin benefit from RFID mix shift. The label and graphic materials segment is not structurally protected from input cost volatility, and a sustained raw material headwind would weigh on overall profitability.
Bear case number 2, tariff and trade disruption hits the global supply chain. Avery Dennison's business is inherently global. They manufacture in dozens of countries and serve consumer goods companies that have complex international supply chains. Tariff escalation between major trading blocs, trade restrictions on specific materials, or supply chain regionalization mandates could increase costs, disrupt manufacturing logistics, and require capital-intensive reconfiguration of the production network. Retail volume is also cyclically sensitive. If consumer goods volumes soften globally, whether from a recession or from trade-driven demand destruction, the label and graphic materials segment faces a volume headwind that Intelligent Labels' growth may not fully offset in the near term.
The bottom line on Avery Dennison: this is a global labeling leader with a quietly powerful RFID growth engine inside it. The Q1 EPS beat of $2.47 against a $2.41 estimate confirms execution quality. The Intelligent Labels segment growing at 30% annually on the back of Walmart and Target mandates is the defining feature of the thesis, and the potential for mandate expansion into food, pharma, and logistics could extend that growth runway for years. The label and graphic materials-based business provides reliable cash flow to fund the dividend buybacks and continued RFID investment. Consensus buy with a $202 target implies 9% upside. Raw material costs and tariff exposure are the primary risks to watch. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.